Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market update, macro trends, sector liquidity, and equity analysis. This video presents a direct informational narration of the source document.
Here's a quick look at the agenda for today's explainer. We're going to cover the market overview and geopolitics, Federal Reserve policy expectations, sector liquidity and squeezes, SPX stock trading dynamics, NVIDIA's debt and strategy, and finally, the recent Amex acquisition and our closing thoughts. Section 1, Market Overview and Geopolitics. So looking at the indices and commodities today, all four major indices actually rose, boosted by a US-Iran peace agreement. That said, the price action was kind of fragmented. The S&P and NASDAQ showed some real relative strength. They pulled back just a bit after an intraday push, but still closed right below their intraday highs. On the flip side, the Dow experienced a late-day drop, and the Russell, it cleanly dropped from its opening peak and kept sliding throughout the entire day. Now, the formal signing of this US-Iran agreement is expected on Friday, potentially over in Switzerland. The actual details are pretty disputed right now. Iranian media reports are suggesting the US signed an unequal treaty, while US media reports are saying Iran signed an agreement just for survival. The true details are still unreleased, but reports indicate the US is going to lift its maritime blockade on Iran, and in return, Iran will reopen the Strait of Hormuz. You know, the biggest positive here is simply that blockaded seamen can finally go out to sea and have a hot meal.
Naturally, this had an immediate impact on global commodities. Crude oil prices dropped significantly today as traders quickly sold off that geopolitical risk premium they'd accumulated during the conflict. The price has returned to $83, though it still remains roughly higher than pre-conflict levels.
Looking at the broader picture, overall sector performance was quite positive today. Technology, communications, and consumer discretionary really led the market. However, energy performed very poorly, dropping over 3% independently. International energy prices are continuing to break downwards, falling from 90, and they're now facing the real predicament of breaking below 80. Just to put that in perspective, if it breaks below that 55.5 mark, a market top will be formally established.
Moving on to Section 2, Federal Reserve Policy Expectations. A major focal point for us this week is Wednesday's Federal Reserve interest rate decision, along with Chair Walsh's press conference. Now, the market broadly expects rates to remain totally unchanged, but all eyes are going to center on what new Chair Walsh actually says in his initial press conference. Specifically, the market is watching closely to see whether the Fed will eliminate easing signals in its statement. Are they going to raise inflation forecasts, lower unemployment forecasts, or maybe release a more hawkish dot plot? Or will they maintain a relatively loose stance? Keep in mind, quarterly Fed meetings always require reviewing the summary of economic projections and those all-important dot plots. We're also anticipating a pretty notable shift in central bank communication following new Chair Walsh's appointment. The Fed's role might actually be slightly diminished. According to a Wall Street Journal report, Chair Walsh wishes to reduce the Fed's communication with the public. His rationale? He believes constant communication just leads to concentrated market speculation, which then requires constant Fed clarification, and that just creates a chaotic environment. Consequently, we're going to see communication reduced, releasing only the absolute core information. So what does this all mean? Well, for investors, the Fed's forward guidance role is going to be significantly smaller.
Next up is Section 3, Sector Liquidity and Squeezes.
According to data from a recent liquidity report, major subsectors like semiconductors and semiconductor equipment are remaining incredibly strong, and this is primarily driven by short squeezes. Right now, some hedge fund positions are experiencing massive covering of squeezed shorts. In fact, the ratio of short covering to long buying is sitting at an extremely high 4.7 to 1. This clearly indicates that many were essentially forced higher by those rapidly accelerating prices. Despite that strong performance in certain subsectors, the broad market data from last week actually indicates net selling. Among the 11 major sectors in the market, 9 were net sold. Calculated in US dollars, information technology, communications, consumer staples, and consumer discretionary were sold the most. Financials and industrials were literally the only 2 sectors to see net inflows. Therefore, we're seeing a very clear divergence between these specific subsectors and the broader market. While last week's performance for the broad market and the 7 heavyweights was pretty poor, today did see some slight gains. However, trading volume was extremely low and positions really didn't change significantly. The 7 heavyweights overall performed well today, actually outperforming the S&P 493 index, which is interesting after they were the most heavily sold group last week.
Over the weekend, news regarding the banning of the Neuropic model definitely raised some concerns about the AI sector. Yet, in contrast, many AI-related subsectors performed strongly today. The PhilX Semiconductor Index hit a brand new high, and semiconductor hardware equipment also performed very well, right alongside hyperscale data centers. These collectively drove the Nasdaq's significant upward movement. The PhilX Semiconductor Index has completely finished an upward breakout, punching right through its top in a continued extremely strong squeeze.
Let's dive into Section 4, SPCX, Stock Trading Dynamics. Turning our attention to specific equities, SPCX rose a massive 19.6% today. This follows a 19.22% surge on its very first trading day, with prices just continuing to soar after hours. Elon Musk even stated on Sunday that SPCX revenue could reach $1 trillion by 2030. The trading strategy over the past 2 days really relies on the stock's low float. Despite having a huge market capitalization and large funding targets, most of the shares are actually locked up. Only about 4.2% of the shares are tradable on the open market. This is what's driving that aggressive long buying, simply because not much capital is needed to actually move the price. We also saw turnover drop from 93% on Friday down to 46% today. This indicates that more participants are adopting a buy and hold approach compared to that crazy high-frequency trading we saw on day one. Right now, the market is basically trading on two timelines: the anticipated index inclusion in early July and the first lockup expiration coming up in mid-August. Options might even launch tomorrow, though that's still unconfirmed, and that would introduce hedging and leverage tools, which will likely exacerbate this high volatility. Trading volume still remains massive, reaching over $40 billion today, even though that's only about half of what we saw on the first day.
Moving forward to Section 5, NVDA Debt and Strategy.
Regarding NVIDIA, Kazakhstan and FEDs just signed a $10 billion artificial intelligence agreement with the company. Additionally, NVIDIA is planning to raise US dollars by issuing high-grade bonds. Initial subscription demand was absolutely off the charts, reaching approximately $85 billion. The bond maturities are going to range anywhere from 2 to 30 years, with reports indicating the 10-year bond is priced 75 basis points above equivalent US Treasuries. So the absolute crucial point here is understanding exactly how this debt functions strategically. This debt issuance does not signal a lack of capital, not at all. NVIDIA currently holds $50 billion to $60 billion in cash and equivalents, plus they have incredibly strong quarterly free cash flow. What this is a strategic capital structure optimization. The company is actively leveraging its A credit rating to issue low-cost debt for high-return investments. We're talking about things like AI infrastructure, new chip development, supply chain prepayments, and potential acquisitions. Crucially, doing this preserves their cash capacity so they can execute large-scale share buybacks when necessary. And that is vital for defending their market capitalization and their overall industry leadership position. Borrowing is simply far more cost-effective for them than diluting equity or draining their cash reserves. It's very similar to Apple's routine strategy of borrowing for buybacks while continuing to hold massive cash reserves.
Finally, let's look at Section 6, MX acquisition and closing.
American Express just acquired The Fork, which is a European restaurant network previously under TripAdvisor, for $700 million in cash. The Fork operates over 50,000 restaurants across 11 different European countries, and they've been generating approximately 211 million euros in annual revenue over the past year, with some very steady growth. This acquisition is a big deal because it expands American Express's restaurant network to 75,000 locations in total, directly enhancing those dining benefits and experiences for their core, high-end cardholders. Since it was acquired at roughly 3 times price to sales, the valuation really isn't expensive. It serves as a positive development that's primarily going to boost market sentiment, rather than significantly shifting immediate revenue, mostly because it's such a small proportion of Amex's total market cap. Fundamentally speaking, American Express offers the most cost-effective valuation among its peers relative to its forward PE. It's currently trading at a historically lower forward valuation level. Technically, the stock actually reclaimed the 330 level, successfully overcoming some very strong resistance. The next resistance levels to watch are at 335 to 340 and 351 to 336 before we could see a potential run to the previous high of 385. In conclusion, the source document takes a nice shift towards market psychology and leisure, taking note of the current excitement around international sports matches. It really emphasizes a great point. Investing is not the entirety of life. Rather, investing is for a better life. This perfectly captures the essence of keeping a balanced perspective in all this. Thank you so much for joining me on this explainer.